Hey, what is going on, guys? If you're new to the channel, welcome. My name is Nick, and today I'm going to be showing you all of the details surrounding the cash flows of my first rental property purchase. Back in December of 2019, I purchased my first rental property, which is a legal up-down, essentially a duplex, up here in Northern Alberta, Canada. And essentially what that means is that there's two totally separate legal suites, and I am living in the upstairs suite while I'm renting out the basement suite. And I've also decided to rent out one of the rooms that are in the upstairs suite where I'm living, so technically the strategy that I'm following is called house hacking. And that is where you live in one of multiple suites in a given multifamily property to be able to cover a lot of your expenses and pay for the mortgage. And so in this video, I'm going to be showing you guys exactly how much I make in terms of rental income, how much I pay in terms of expenses on a monthly basis, how much my mortgage payment is, and all of the other details that you might want to know. But on top of that, I'll be showing you exactly how to calculate all of the cash flows related to a rental property that you're living in. And that would include your cash on cash return, your total rate of return that I'll get into later in the video, and a whole lot else, so definitely make sure to stick around until the end. So if you do enjoy this video, I really would appreciate it if you could smash that like button for me. It really helps out my channel, and I put a lot of time and effort into making this video and calculating the numbers for you. But also, if you're new here, definitely consider subscribing for more weekly investing videos just like this one. So with that said, let's get into calculating my first rental property numbers. Alright, so because of the nature of this video having so much detail and so many numbers and calculations, I've decided to break it up into different parts. So in part one, I'm going to be talking about the mortgage, the property details, and the investment amount. Alright, so as I said, I purchased a legal up-down house here in Northern Alberta, and that cost me $350,000 for the home purchase price. As for the down payment, I decided to put 20% down, which equated to $70,000, and that way I could avoid all of the CMHC insurance fees over here in Canada, which would be required for a down payment less than 20%. And if you are considering buying a home but you don't have that 20% down payment yet, I would highly recommend that you do build it up to a 20% down payment at the minimum so that you can avoid all of those CMHC mortgage insurance fees. Now, after doing a lot of evaluation with different banks around the city, I managed to get my mortgage with TD at an interest rate of 2.79%, which was of course the best offer that I received. And the main reason that I went with TD Bank over any other bank here in the city is because TD was going to offer me $1,000 back on my principal on my mortgage just for having a bank account open with them. And based on the home purchase price, the down payment, as well as the interest rate that I got, I end up having a mortgage of $1,297 per month. Now, of course, when you're buying a home, it's not just the home purchase price that you're going to be paying. You're actually going to be paying a lot in closing costs, namely the home inspection, the conveyancing fees with the lawyers, and many other fees depending on the location that you're living in. But thankfully, where I'm from over here in Alberta, there aren't any land transfer taxes, which is a miracle, so I didn't have to pay those, and my only fees were the home inspection, which ended up being $420, and then the conveyancing fees, which were $1,280, totaling up to $1,700. And finally, one last fee that many people forget about when they're buying a home is the moving expenses, and for me, I had to rent a U-Haul, which cost $800 approximately to be able to bring all of my stuff up from my hometown in BC all the way up to Alberta, and that cost $800. So if we sum up the down payment, the closing costs, and the moving expenses all together, we end up coming up with the total cash investment that I put into this property, which ended up being $72,500. So in the next section of this video, I'm going to be calculating all of the revenues and the expenses of this rental property, and that way it should eventually lead us to a cash on cash return on investment. Alright, so getting into the revenues or the income that I'm generating from this property every single month, we have to look at two areas. First being the upstairs room that I'm renting out, and then second being the basement suite that I'm also renting out. So in the downstairs suite, I'm renting it out for $1,300 per month, where the tenant is responsible for paying for their own utilities, being natural gas and electricity, but then water is included. And then for the upstairs room plus their own bathroom, where the tenant is living in the same space as me, they end up paying $850 per month. So in total, the revenue generated from both the downstairs suite as well as the upstairs room ends up being $2,150 per month. But of course, I don't get to keep all of that or anything close to it, because there are a lot of property expenses that I do have to cover, and that's what I'm about to get get into. So first and foremost, the biggest expense that I have on a monthly basis is the mortgage payment, as expected. And as I told you before, it ends up being $1,297 per month. And on top of that, I'm also responsible for paying all of the property tax on this property, which ends up being $383 per month. And just so that you're aware, property taxes are a function of the property value, the neighborhood that you're living in, as well as the area of town. So it really depends on the property that you're going to be analyzing what the property taxes might be. But you can generally get the last year's estimate if you look it up on the city's website. So that's typically what I did to analyze a property in advance. Now getting into the third monthly expense, and that is home insurance. And that ends up costing me just about $105 per month, which is actually a little bit lower than most properties, but that is because I have a 2012 home and it's only about 8 years old. Now, of course, the next biggest expense in any home is obviously going to be the utilities, and that includes your natural gas, your electricity, as well as your water and sewer, and garbage and recycling. So based on 1 month's estimate, my water and sewer bill ended up being about $90 per month, and that includes the water for both the downstairs suite as well as my suite that I'm living in. But then moving over to the natural gas and electricity, I'm actually only paying for those in the upstairs suite because the tenant has to pay for their own downstairs, and it actually ends up being about $125 per month per utility in the upstairs. And yes, the natural gas bill is super high, but that's because where I'm living is actually very cold up in Northern Alberta, and $125 per month is probably a fairly conservative month. Then for the garbage and recycling, that ended up being about $60 per month, and the internet bill, which is my final utility, ended up being $57.70 per month. Now on top of this, there are even more expenses. It's probably hard to believe for non-homeowners out there, but two things that you do need to account for if you are planning on buying a home are the maintenance costs and the capital expenditure costs. Maintenance involves just fixing things around the house that might break down or replacing furnace filters, things like that. And for me, it ends up being about $107 per month because I'm estimating about 5% of my rental income is going to the maintenance. And on the other hand, we have capital expenditures or CapEx, and that accounts for any type of improvement that you do to your house at all. And that could include replacing the hot water tank, replacing the roof, replacing some of the appliances, replacing the flooring, etc. And in my case, I estimated about 7.5% of the rental income is going to go straight towards the capital expenditures, which ends up being $161 per month. And finally, we have the last expense on the list here today, and that is vacancy, because you don't know when your tenants are going to be in the property, or if you're not going to be able to find the next tenant. You really don't know in the future, so you have to account for vacancy in your property. And in my case, I accounted for 1 month out of the year that I'd have my place vacant, and so in that case, it ends up being $179 per month of vacancy. And if we end up totaling all of these expenses for the month, it ends up being $2,691 per month. So now that we know all of the total monthly revenues and the total monthly expenses, we can subtract the monthly expenses from the monthly revenues to be able to get the monthly cash flow, and that ends up being a negative $540 per month. And based on that alone, anyone watching this video would think, why the heck am I investing in real estate? I'm losing money each month, this is unprofitable, what the heck? And technically you would be correct in thinking that I am out money each month, but there's one thing that we didn't account for yet, and that is the principal pay down on the mortgage, also known as the equity building in the property. And with that, let us enter the third part of the video, being the principal paydown and the return on investment. Now, if there's one thing that is most famously misunderstood about homeownership, it would hands down have to be the mortgage payment. Although being one single payment that you have to make on a monthly or a bi-weekly basis, the mortgage payment actually consists of two different parts, those being the principal portion and the interest portion. Now, the principal portion is what's being paid directly into the house, or you're gaining the equity in the home, and you actually get to keep that amount that you're paying into the home when you sell it, assuming that the home price stays about the same or it appreciates. And on the other hand, we have the interest payment, and that is the payment that you're making to the bank for loaning you the money. And the way that each of these two portions is calculated is based on the home purchase price, the interest rate, as well as the term length of the loan. And in order to make this video complete, I'm gonna go over an example of calculating the interest portion and the principal portion of my mortgage payment so that you guys have a general idea of how it works. So in my scenario, I have a mortgage of $280,000 at an interest rate of 2.79% over a 25-year lifespan. And as I said before, my monthly payment ends up being $1,297 per month, but that is broken up into the principal and the interest portions. So to be able to calculate the first month's interest portion, we take the mortgage value of $280,000, multiply it by the interest rate of 2.79%, and divide it by 12 months in a year, and that gives us $651 of interest paid in the first payment. And then it makes it easy to be able to calculate that principal portion on the first mortgage payment. So what we do is we take the total first mortgage payment of $1,297, subtract off the interest of $651, and then that leaves us with $646 of principal. And so by making that first mortgage payment of $1,297, $646 of that payment is going straight into my house. And so that brings my mortgage amount down to $279,000 and $353. I honestly can't believe I just remembered those numbers. Now, if we repeat this process on the new mortgage balance every single time, you begin to see that the interest payments actually decrease over time, and that is because you're basing the interest payments off of the new mortgage balance, which is less than $280,000. And simultaneously, we find that the principal portion is increasing over time, and that is because the mortgage payment stays the same while your interest portion is actually decreasing. And I'll put a graph up on screen to illustrate exactly what I'm talking about, because this is a pretty complicated topic and a lot of people don't really understand how it works. But basically, all you need to know is that as each month goes by, I'm paying less interest to the bank, and then as each month goes by, I'm going to be paying more into the house, which is more money to myself. So in the first year of owning the home, I'll end up paying $7,857 in principal, and then $7,712 in interest. But then if we compare that to the second year of home ownership, I'll end up paying down $8,079 in principal, and then $7,490 in interest. So as you can see, I start paying down more in principal and less in interest, so it ends up being a better deal for me as I hold the house. And basically what I'm saying here, and that I've tried to sum up in all of these calculations, is that I need to take into account the principal portion when I'm calculating the rate of return on my investment. So the rate of return is essentially the amount of money that you're getting each year compared to the amount of money that you put down initially. So if we only consider the first year of home ownership, where I end up paying down $7,857 in principal, we can calculate the total return on investment by adding the total annual cash flow that we calculated before to be negative $540 per month times 12 months in the year to give us a negative $6,488, and add this to the total amount of principal that I paid down, being the $7,856.90, and dividing it by a total cash investment of $72,500 to get a rate of return of 1.9%. Now that really doesn't sound too great, considering that you can put your money in the stock market and get an 8 to 10% return. But what we need to do is actually account for the cost of rent that I would otherwise be paying if I were living in someone else's house where I was the renter and they were the landlord. Because now that I'm living in my own place, I no longer have to pay rent to my previous landlord, so I'm effectively saving that amount of money every single month. So when we add in my previous rent of $800 per month as a monthly revenue in my case, because I'm no longer having to pay that to my landlord, I'm saving that money every month. The cash on cash return now changes from a negative 8.9% to a 4.3% per year. And this cash on cash return just means the amount of cash that I'm saving every single month in my bank account for living in this property relative to what I was paying when I was renting. So the way that you can look at it is I'm essentially making a 4.3% return on my investment by living in my house and saving on that extra cost per month. But then when we calculate the total rate of return that takes into account the principal pay down of the mortgage payment, the rate of return actually changes from 1.9% to a 15.1% per year. And of course, these numbers are only based on the first year of homeownership, so they will get better over time, meaning my rate of return will increase as I guys start paying down more principal as time goes on. Alright guys, so now in the last part of the video, I just wanted to go over some other benefits of home ownership if that previous part did not make any sense to you. So when you have a rental property in the US or in Canada, a lot of the expenses that you have to pay every single month can be written off as a tax write-off. So for example, if you were fully renting out a rental property and you had a monthly expense of $1,000 per month, you could probably take a full tax write-off on that, and if your average tax rate is 30%, you could actually save on $300 per month by not paying tax. But of course, I'm not an accountant, so you definitely want to look into the details yourself or talk to your own accountant about it. I'm just here to say that it does exist and it will benefit you as a homeowner. And the second thing that you need to know about is that properties generally appreciate over time. And as an average, in the past, properties have typically appreciated about 3%, depending on the area that you're in, but on average, it's typically about 3%. And here in Canada, if you're living in the property that you're renting out or that you own and you sell it, you're actually not going to pay any taxes on the capital appreciation that you just made. So let's say I bought a property for $200,000 and it appreciated 10% in the time that I lived there, and I go to sell the property for $220,000, I would get to keep that $20,000 extra as profit. So obviously there are a multitude of ways that you can benefit as a property owner, especially if you're renting out the property and gaining that rental income and the tax write-offs. So anyways, if you guys did stick around until this point, I really appreciate it. This was a difficult video to make, and I would appreciate a like if you did enjoy it. Do let me know down below if you own your own property or if you're planning on buying your own property, and if you're going to be doing the rental property calculations like I am here. But overall, I really hope this video provided you with some value, and if any at all, definitely consider subscribing for more content on personal finance, business, and investing in the near future. And I will see you guys in the next one.